Welcome to the Hughes Optioneering weekly workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at WGS, or Genedx Holdings Corporation. WGS is at the forefront of transforming healthcare through its industry-leading exome and genome testing and interpretation. Here's the BarChart.com technical opinion rating for WGS. The bar chart rating is a 100% buy, with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, the stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. As you can see, WGS stock price is well above the moving average line, so the monthly trend in WGS is up. Now we're going to look at the daily chart. The stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since the chart started, so the daily trend in WGS is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. WGS is below the upper Keltner channel line, so WGS is inside the buy zone. Since the trend is up, we want to buy a call. WGS has 9 option chains to choose from. We're going to use the April 17 chain. Right now, the April 17 options have 33 days to expiration. Here's most of the WGS stock chain for April 17. WGS closed at 98.47 on Friday. That means any calls on the list from 50 to 97.5 are in the money. We're going to try to buy or look at buying the 97.5 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 97.5 strike call is 9.90 to 11.40. We tried to enter at the midpoint, so we use 10.65 as the buy price. Our call option purchase calculator shows the profit potential for WGS based on WGS price changes at option expiration from flat to a 12.5% increase in price. We can see that if the WGS stock price is flat at 98.47 at option expiration, the 97.5 strike call will lose 90.9% of its value. We want that to be break even or better, so the 97.5 strike call does not meet our requirements. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1%. For the call option, we purchase to break even and start profiting. Now let's take a look at buying the 80 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 80 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the WGS stock price is up 1%, the 80 call will lose 11.8% of its value. We want that to be break even or better, so the 80 call does not meet our requirements. Let's see if the 65 call will work. The bid-ask spread for the 65 call is 32.30 to 37. We try to enter near the midpoint, so we'll use 34.25 as the buy price. The 65 call works. If the WGS stock price is up 1%, the 65 call will make a 0.6% or $20 profit. That's better than a break even, so the 65 strike call is the one we'll buy. The call option purchase calculator also shows that if the WGS stock price increases by 2.5%, the 65 call will make a 4.9% or $168 profit. If the WGS stock price increases by 5%, the 65 call will make a 12.1% or $414 profit. If the WGS stock price is up 7.5%, the 65 call will make a 19.3% or $661 profit. The plus 10% and plus 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the WGS stock price does not make the expected move up and remains flat at expiration, the 65 call would only lose minus 2.3% or minus $78 compared to the minus 90.9% or minus $968 loss for the 97.5 strike call that we looked at earlier. Now we want to review, a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the WGS April 17 expiration 85 strike call and sell to open the April 17 expiration 92.5 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 85 call for $17.95 and sell the 92.5 strike call for $13.80. $17.95 minus $13.80 equals $415. So the entry price or debit cost for the spread is $415. The call option debit spread analysis calculator picture shows that the spread will make an 80.7% or $335 profit if the WGS stock price declines by 5%, remains flat, or increases in price when the options expire. If WGS is down 7.5% at expiration, the trade will make 46.6% or $193. Creating the debit spread will allow us to collect a $1,380 cash credit to our brokerage account for the sale of the 92.5 strike call. As we said in the previous slide, this reduces the cost of entering the spread to $415. Here's a note regarding earnings reports. The next WGS earnings report date is May 5th. Let's review the trades one more time. The first trade was a call purchase. Said to buy to open the WGS April 17 expiration 65 strike call for $34.25. We also reviewed the spread. The spread said to buy to open the WGS April 17 85 strike call and sell to open the WGS April 17 92.5 strike call at a debit of $415. Thank you for joining us. We look forward to seeing you again next week.